Hey everybody, Matt Graham, MBS Live here with you on Wednesday, March 25th, 2020. Bonds are doing okay, a little bit weaker today. MBS about 5 ticks weaker, but I'd rather focus on the bigger picture, at least while we're still talking about MBS. Pull up a 5-day chart with 2.5, see it level off nicely there, just over 103. That is a very good price point historically. Closing at 103.07 today means that we are matching the highest close ever back in September on the 24th, 2012, right after QE3, which targeted MBS buying specifically. That was the good one for us. It also made the Fed sort of an inextricable part of the mortgage-backed securities market, something that they have reinforced recently with all of their huge support and their $50 billion a day of eligible purchases. That's been interesting. We can line up the purchase timeframes with big changes in liquidity and volatility in MBS. I posted a chart of this earlier in the day. If you pull up the alerts menu, it's the one that says, so this is happening. And you can see that at 9:45 and 11:45 that the bid-ask spread widened out, means buyers and sellers got farther apart from each other. And especially after 11:45, buyers sort of went away and sellers that needed to sell had to chase them. There are definitely sellers out there that need to sell and are just trying to avoid selling at lower prices than they want to. This is happening not only in TBA, MBS, but especially in the other corners of the mortgage market where people are trying to sell things like servicing, which is taking a big hit and is in a very uncertain stance right now due to a variety of issues, but this forbearance and payment deferral thing is causing a lot of uncertainty, and it might be cleared up by, well, not cleared up, but at least helped by the disaster relief bill that's on the table right now. It might make it to the president's desk very soon, and we don't have confirmation at this point whether or not this particular clause will be in there. But even if it's not, I am personally holding out some hope or faith that due to Fannie and Freddie being a cash cow, if you will, for Congress, or at least due to the fact that Congress is aware that Fannie and Freddie generate a significant amount of income for Treasury, that they are aware that this particular clause will help Fannie and Freddie's profitability. It will also help financial stability in the mortgage market. It's the kind of thing that makes a lot of sense. Obviously, if you're going to offer forbearance opportunities for a ton of loans, you pretty much have to make sure that that's not going to cause a ripple effect that makes those loans significantly more expensive in the future, or makes new loans significantly more expensive for people that are refinancing or buying right now. And I do have faith that that will either be part of the bill or be worked out shortly thereafter due to a bunch of outcry or some other workaround that comes into play without needing to be passed into legislation. I'm sure between the Fed and the Treasury and the GSEs, they could figure that out if they needed to, but hopefully they don't have to get too creative to do so. That means, though, that it will continue to take time and market stability for spreads to come in. We're in a process right now where there's latent momentum away from anything that's not purely 100% vanilla, down the middle, conforming conventional 30-year fixed. Even 15-year fixed stuff is taking a hit because it is less of a market. It's a smaller market than Fannie 30s. So if you click on 15-year prices, you can see they're closer to 30-year prices than they have been in a long time. And in fact, 30-year 3.0s and 3.5s are doing even better than 15-year fixed. But that's not a defining issue for the mortgage market right now. It's more to do with the servicing valuations and volatility, hedging costs. The credit lines and warehouse lines that lenders use to fund loans are not necessarily shutting off. In some cases they are, but they're limited. The margins have increased, and it is reflected in the fact that mortgage rates continue to be very high relative to where they had been historically when MBS are at these levels. I wouldn't say very high, but how about this? Very high for some lenders. In fact, excruciatingly high for some lenders. In fact, I would say this is the biggest, widest, most volatile spread of available rates between lenders that I've seen. In 2008, if this stuff was going on, you would just see them drop and they would be dead. In 2020, a lot of lenders can stay in business and then just raise rates, raise costs, or turtle up for a little bit. But as they do so, their rates go prohibitively high, and you have some actual healthy big name lenders that are charging rates that are like over 4% right now, while other lenders are able to offer rates that are 3 1/8, 3 1/4. And that's a legitimate spread from legitimate, healthy lenders in the mortgage market. To whatever extent, the mortgage market is healthy right now, and I'd argue it is healthier than it was in 2008, but not without its problems. So the disaster relief bill passes, let's say that happens, and that clause is in there, and some more time passes, and bonds stay stable, and the Treasury basis stays stable. Pretty soon, eventually, this momentum, these dominoes that are falling kind of behind the scenes in the secondary mortgage market will slow down, and things will start to come back, but it's going to take time. So just be patient, I guess. I know that doesn't work for some of you. It wouldn't work for me if I was beholden to one lender that had rates I couldn't sell, but it's an opportunity to make a game plan with your clients and be ready to lock the rates when they come back, and they will come back eventually, and then you'll be ready to pull the trigger. And it's hopefully going to be that simple. I'd be surprised if it's not that simple, but let's be clear about what I'm saying. I'm not saying float all your loans and hope for all-time low rates soon. I'm saying if you are with a lender who is going to still be in business in a couple weeks and your rates are currently blown out, there is hope for you to see those rates come back down. But feel free to have a brief, candid conversation with whoever you need to at your company to see if that's an okay thing to be saying to your clients. They'll probably let you know whether it is or it isn't. They don't really want any more drama than you, but do be aware that all the folks in the secondary mortgage market that are dealing with setting rate sheets and whatnot are not having scotch and cigars in the bar after work. Yeah, they can't go to bars in most cases. And celebrating their victory at gouging you and charging your clients higher rates. They are under more stress and having to deal with more crap than they've had to deal with in a long time, some of them the most ever. So it's a real mess in the secondary mortgage market. Just be aware of that. Your client should be aware of that. And it's not about anybody taking advantage of anybody else. It's about people trying to survive and do so in the most graceful way possible, or the least risky way possible. And we will get through it. As far as locking and floating goes, if you are with a lender that has those high rates, all you can really do is make that game plan and then execute when you have rates that excite both you and your client. If you have access to those super low rates, lenders are doing this hokey pokey, 2 feet in, 2 feet out sort of thing when it comes to offering really good rates, taking a bunch of locks and then repricing for the worst based on capacity versus MBS. So when you see those really nice low rate opportunities come into play, I think most of you know by now, if you didn't just start originating this week, most of you know that it makes sense to take those off the table when you're seeing stuff like 3 1/8, 3 1/4, or the equivalent of whatever it is with your small amount of LLPAs you might have on a certain deal. So when I say 3 1/8, 3 1/4, I'm talking about, more than 30% down, more than, super high credit scores and owner occupied, all the good stuff. So adjust accordingly if you're not. Oh, and do be aware that if you are talking about condos, non-owner occs, lower credit scores, higher LTVs, you are pretty much screwed because the stack is compressed, as they say. And what that means is that the MBS coupon offerings are very close in price relative to where they would be in a more stable market. And that means, the reason for that is that investors are generally terrified about anything that has a higher coupon because those are higher rate loans. And the higher the rate on the loan, the more the risk that it will be refinanced in a low rate environment. So valuations on those are not good. They are also loans that are more likely to be in forbearance because of demographic issues, relating to credit quality of the underlying pools. That's not necessarily, the case depending on certain lenders, certain pools. Like if it's heavily high credit score, non-owner occupied, it might not be as big of a deal. But if it's like lower credit score, higher LTV stuff, it could be a bigger deal. So if people are losing their jobs, and doing the forbearance thing, then those loans might face a higher risk of prepayment if people need to sell their homes, or if even after the forbearance, if people have a hard time paying, then, looking at short sales, foreclosures, things like that. But that's pretty speculative at this point. The point being of, the point of what I was saying a second ago is that once you start pricing in those higher LLPA type deals, there just isn't good pricing in those higher MBS coupons to accommodate that. So you're not going to be able to get any advantageous terms for stuff that has a bunch of LLPAs right now. That's just the way it is, whether we like it or not. Will that change? Yes, eventually. But again, time and stability. How much time? I don't know exactly. At the very least, you're not talking about something that's going to get way, way better in a matter of a couple weeks. That coupon stack issue is like a month's sort of issue, most likely. Best case scenario, maybe 3-4 weeks. Things could improve a little bit. Things could improve a little bit, even sooner, but meaningful improvements, the kind that you would be more excited to talk to your clients about. We're talking probably at least a couple months. Hard to say, but it will eventually happen, which is the nice thing, but maybe not as fast as you want. So focus on, what you can control right now. It's going to be true for a lot of people in a lot of scenarios. Focus on the fact that if you're an originator right now, you have a job, which is great because a lot of people don't. Help out where you can, do what you can for your community and all the rest of that soapboxy kind of stuff. That's going to do it for me today. Back with you guys tomorrow. Have a great rest of your day.